Management accounts differ from financial statements. Often referred to in the textbooks as managerial accounting, management accounting is a relatively new field of study in the dynamic world of accounting. Unlike financial accounting, where financial data is summarized into reports for presentation to a wide array of users, for example, banks, creditors, SARS. With management accounting, the process of preparing these reports is specific to management. Needless to say, management accounting could be defined as the analysis of both quantitative and qualitative info for the purpose of improving efficiency and effectiveness within the business dynamic, whether big or small. Our reports for management accounts generally comprise a balance sheet, an income statement, and for some color and interest, charts and graphs. Starting with the income statement provides the results of trading operations for a given period. Reporting is normally on a month-by-month basis with a year-to-date cumulative total. You can see that on the far right-hand side. The income statement can be prepared to compare with the current month's budgeted figure and with the actual figure of the same month for the previous year. The income statement can also be divisionalized for bigger businesses, which comes with a variety of interesting scenarios like silo accounting, where you have different divisions and how to allocate costs between the divisions, and also how to cross-charge from one division to the next. In terms of layout and presentation, at the top we have sales, followed by less cost of sales, which gives us gross profit. This is often reflected as a percentage of sales and helps to identify the variance between actual and budgeted markup. In your management accounts, if your actual GP percentage is significantly less than budgeted, then investigation is warranted. You'll see a less expenditure row, ranging below it alphabetically from A for accounting fees to W for workman's compensation. And this finally gives us the net profit, being the difference between gross profit and the expenses. With management accounts and the use of ratio analysis and interpretation, variances from the norm are spotted sooner rather than later. As I said earlier, these are done on a monthly basis. Moving on to the balance sheet provides the financial position of the business at the end of a given period. Reporting is normally such that the current month-end figures are compared with the same month-end figures of the previous year. In terms of layout and presentation, at the top we have assets as a main component of financial position, followed at the bottom by liabilities as the next main component, with the resultant owner's equity in the middle as the last main component. In very simple terminology, assets less liabilities is equal to owner's equity, which is the net asset value of the business. In other words, the financial position of the business at the end of a given period. Under assets, we distinguish between non-current assets and current assets, which are arranged in order of least to most liquid. Under liabilities, we also distinguish between non-current liabilities and current liabilities. As far as non-current assets and non-current liabilities are concerned, the rule of thumb is that acquisition of long-term assets must be achieved with long-term finance. And as far as current assets and current liabilities are concerned, often referred to as the working capital of a business, the rule of thumb is that the ratio of current assets to current liabilities should be 2:1. Anything less than this might suggest any number of sleepless nights, depending on how much less than the 2:1 ratio you find yourself in. Owner's equity should never be in negative territory and is essentially the accumulated profit of the business since inception. And finally, charts and graphs. There is no better way of demonstrating important points than with a bar or pie chart. This visual presentation gives clients a quick snapshot summary, which is easier to understand. It's commonly known that most successful entrepreneurs swear by management accounts to monitor the performance of their businesses and to help them make informed decisions. At RSM, we provide a comprehensive managerial accounting offering, which includes payroll and VAT.